Excel accounting practice problem. Reversing entry, loan payable, short-term and long-term portion. Get ready because we're going to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet, now continuing to enter transactions into it if you have access to it. There's two tabs on down below, an example tab and a practice tab. Practice tab starting out where we left off last time. The example tab in essence being an answer key. We're going to be staying on the practice tab this time. In the last presentation, we did the adjusting entry, breaking out the short-term and long-term portion of the loan, recalling that we discussed a few different loan options or options for the tracking of the loan, the primary objective being that from the bookkeeping standpoint, we would like to make things as easy as possible to enter the payments and possibly tie out to the amortization table as we go. I would think generally in my perspective that is often to have one loan account per loan, possibly in the current area in a current liability type of account, and then be able to track the payments to the actual amortization statement on a per loan basis, possibly also having sub accounts for those loans to a parent account, allowing you in accounting software like a QuickBooks or something like that to be able to collapse them into the parent account or extend them as the needs might be for presentation or internal purposes in the usage of them. And then on a periodic basis, monthly or at the end of the year, when we're presenting the financial statements, then break out the long-term and short-term portion with an adjusting journal entry as we did last time, breaking out the short-term and long-term portion. And then after we have done that, we don't want to mess up the accounting department. So then we're going to collapse it with a reversing entry, once again, bringing us back to the one account per loan, making it easy for the accounting department. So let's give a quick recap on where we stand with the amortization table. I'm going to hide from the skinny on the left-hand side, going all the way to the right till we get to our amortization table, which is way past the subledgers, the payroll stuff. There it is. It's in HM. Right-click and hide all that stuff. So last time we broke out the short-term and long-term portion thusly. And so now we're just going to reverse it back out so that we're back to the starting point where we were last time. So here are those short-term and long-term portions, short-term, long-term that we saw in the amortization table, and then we'll get back to here, which is the balance as in accordance with the amortization table if we were to just look at it in one account. Okay, so then the adjusting entry was a straightforward adjusting entry. We're just going to do the exact opposite. I'm going to put it down below. I'm going to format some cells down here so we can just fit it down here. Selecting some cells, going to hit the paintbrush and put some blue paint right there. Paint some blue so that we have some room. And then this is on 3-1. This is a reversing entry. And by the way, while we're here, you might want to, of course, be putting our notes. I kind of stopped doing the notes. So the notes up top, like this note, I might want to put a note here and say this is a note for, this is a to record depreciation according to depreciation schedule from tax software, something like that, to show us where it came from and so on. The accounts receivable and the unearned revenue, you might want to note there. So we might want to say we're going to make a note, new note to increase customer deposits in AR for prepayments and record related unearned revenue. I probably spelled that wrong, but just to give you an idea, the note could be helpful, of course, for future people working on this. And then this loan, we can say, we're going to say, make a note to break out short-term and long-term portion according to amortization table, something like that. And then we could reverse it here, and we're going to say note, new note, reverse adjusting entry for loan so that book, let's say accounting department has only one account they can agree to amortization table, something like that. And then I'm going to reverse it. There's only 2 accounts, so I could like put the debit on top, but I'm just going to keep with the system we've been doing here to just keep the same order from top to bottom and reverse the debits and credits, which I think is going to be easier in the event that we have those longer accounts. And then I'm going to make this the credit up top now. Looks a little bit funny, but I think it's kind of easier to see what's going on, putting it in the credit side instead of the debit side. And then we just reversed this transaction and then reverse the debits and credits, keeping the order of top to bottom, changing the credits and debits. That could either be, I think that's easier to see. Oftentimes that could mess up, like when you're doing these adjusting entries, you also have to consider who you're providing these for. So if you're providing them to a supervisor or something like that, that's going to review your work and they can't stand having credits on top or something like that, then you're going to have to do whatever the common system is that you're working in at that point in time. But that's what I'm going to do now. So we're going to say here is the loan payable up top, the short-term portion. So we are in AP17 equals, we'll scroll back on down, and we're going to be picking up then that 56770. That brings us back up to the 69878. And then we're going to go down here and say in AP22, this is going to be equal to then the loan payable here, and enter, bringing it back down to 0. So what we did then is in the adjusting department, we started here, the 69878. That ties out to the amortization table if we had just one balance as of that point in time. And then we did an adjusting entry, taking it down to the 13108, which is the current portion according to our amortization table calculation. And then we reversed it, getting us back to that point in time so the accounting department doesn't have to deal with 2 accounts when they're entering the transactions. We added this new account down below. Want to be careful when you add the new accounts in the event that you're going to have the accounting department put them in place so that you have them in the right order. And you want to kind of be aware of that because that could cause problems down the road. And then we basically adjusted the long-term portion, making it easier to do the financial statements based on this worksheet, which we will do shortly. And then we reversed it back out, bringing it on back down to 0. No impact on the income statement. We're not going to be recording these to the GL. The general ledger is basically reflecting where we stand as of the point in time at the end of the time frame at this time. So that's where we stand as of now. Here's the trial balances, year to date and the day after. The year to date, the cutoff, and the day after.